I'd like to thank everybody for joining me today. Today, I want to talk about using life insurance in estate planning. And I think this is an important topic and often overlooked about how life insurance can be utilized in the estate planning process and how big of a benefit it can be. If we look at life insurance, the big benefits of life insurance, well, it's a tax-free death benefit. But however, that's an income tax-free death benefit, and a lot of people forget it's not an estate tax-free death benefit. We can grow the tax-free cash value inside the policy if it's properly designed. We can get access to the policy without worrying about RMDs if we don't want to touch it. There's no limits on contribution amounts, and we can add all of these important riders. Now, I think a lot of advisors stop. They stop at that point and say, this is a great tool for death benefit. It's a great tool for building cash value. It's a great tool for all of these extra benefits. But they're focused on inside of the estate. Now, that might be the right answer. But when we're moving it outside of the estate, we've got to take those extra steps. The other thing, in most states, the cash value of life insurance is protected, but there's a large amount of states out there that don't protect the cash value inside of a life insurance policy, so it's subject to creditors. So when you start looking at all of those, now you start asking the question, should this policy be outside of the estate? And if we want it outside of the estate for the benefit of a spouse, children, grandchildren, we've got to take those extra steps to make sure that policy is protected. So let's look at how we can structure an ILIT, an irrevocable life insurance trust. Anytime that we're working with an irrevocable trust, we've got to figure out who's the grantor. Now, this grantor can be one person, can be both spouses, however we want to set that up. Now, my preference is do it on one spouse if we've got a single life policy. If we have a joint life policy, and we'll cover this on another call, how we would do that. But for a single life policy, think about this. In this case, let's just use husband as the grantor. He's going to be the one that sets up the trust. He's the one that decides what the terms of that trust is going to be. And all of this is designed to make sure this policy is outside of the estate tax. So we'll talk here in a few more slides about how to get the money into the trust, but let's assume that we do that right. We've set up the trust, husband's the grantor, now we've got it outside of the estate. Now, we can set this up as a grantor trust. What that means is during husband's life, any tax events inside of that trust would be taxed back to dad. Now, if it's just life insurance in the trust, we're not generating any income tax, therefore it's a non-issue. But if we're going to put other assets into that trust that are income generating, having grantor trust status is big because all of that tax that dad pays on the income from the trust is not treated as an additional gift. Now, this is something that Congress was looking at a couple of years ago, eliminating grantor trust status. That's just something that we've got to be aware of, and that will be a prospective change in the tax law. So if we see it coming, we can do a lot of grantor trust planning ahead of time if we need to. If dad is the grantor, we can make mom, the spouse, the lifetime beneficiary. We can also make mom the trustee of the trust, and then give mom the access to the cash value in the policy, any of the other assets that we put in the trust. We can distribute for health, education, maintenance, and support. Whatever we want to set that up, mom will have access to this policy during her life. Dad can't touch it, but mom can and take care of that. So we've now taken care of mom for her life. And if we have spouses and they want to take care of each other, two trust, two policies. They can't be exact mirrors of each other, but they can be close. But this allows for now this asset to be out of the estate, this life insurance policy that's going to have a big death benefit. is no longer going to be subject to the estate tax on dad's passing. Now mom gets to use that during her life, and whatever mom doesn't use, we can now pass that down to the rest of the heirs. If we keep it in trust, and if we keep it in trust and set that up as a dynasty trust, a multi-generation trust, typically I like setting them up in Wyoming or Nevada, but those trusts can last virtually forever. So think about this, as we're passing this benefit from generation to generation, we're not going to be subject to a 40% estate tax or whatever it gets changed to in the future. That's a huge benefit. Plus, if you think this through, what we've accomplished here, we not only got it out of the estate for estate tax purposes, but dad, whatever assets dad has transferred into this trust are going to be protected for asset protection. During mom's life, she doesn't have to worry about, if she gets into a car accident and gets sued, whatever it is, mom's asset is protected. Mom's, the money to take care of mom during her life is protected. Now we pass it estate tax free down to the next generation or future generations. At each generation, whatever's left in the trust is protected. So the principal is going to be protected. Each time that we make income distributions, now that income to a grandchild, they might be subject to creditors on the income that's distributed. But if that's the case, what we would do, instead of distributing money out for a grandchild to buy a home, maybe the trust buys the home and lets the grandchild live there. We can really create some significant wealth inside the trust for generations and ongoing. Now, once this trust is set up, we have to make sure that dad, in this case as grantor, funds the trust properly. And it's not just one. Dad can write a check and pay the premium. Dad's got to go through how that premium is going to get into the trust and how it's going to be accounted for the estate tax. First of all, we've got the annual gift tax exclusion. Now, if we're using multi-generation tax or multi-generation planning here, we may want to skip over the annual gift tax exclusion and use the lifetime exemption. If we're using the annual gift tax exclusion, the trustee has to get crummy letters signed every single time there's a premium due. Every time dad puts money in, we have to make sure those crummy letters are done, or the annual gift tax exclusion is not going to apply. So that's a big thing that we've got to do. It's going to happen annual as long as we're putting money into the trust. We can use the lifetime exemption, and we can use the generation tax skipping tax exemption at this point. What's nice here, it's out of the estate, don't have to worry about it. And if you think about it, let's say dad transfers in $1 million in here. Well, that's $1 million of exemption used, but it might be for a $10 million death benefit. If that's in the estate, that death benefit is going to be treated as part of the taxable estate, and we're taxed on 10 million, not the million that we moved out with the lifetime exemption. We can make a loan, whether that's a family loan, whether that's a true third-party loan, premium financing. So it can be a personal premium financing, it can be third-party premium financing. A loan is a great way to move the asset, money into the trust, assets into the trust to pay the premium without using our lifetime exemption, especially for large estates where we might have already used up our exemption. Finally, we can use techniques like grants or sales to a defective trust. Those are great tools, to be able to move large amount of assets, leverage gifting, fund the trust in a way that is going to, get the money in that we need for the life insurance, making sure that we reduce the estate tax. But all of these are just tools to make sure we fund the trust properly. We know we've got to set the trust up properly, and then we've got to maintain the integrity of the trust throughout the existence of the trust. So if we want life insurance in the estate plan, take the next step and decide, do we need it out of the estate? And is this going to help our clients achieve their goals? Appreciate everybody getting on. If you have questions, feel free to reach out. And if not, we'll talk again next week. Thank you.